Hello, everyone, and welcome to our fourth quarter housing outlook. Our focus today is on Texas. I'm Ali Wolf, Zonda's chief economist, and I'm pleased to be joined today by Bryan Glasshagel, Zonda's senior vice president of advisory and Texas expert. As mentioned, we are with Zonda. Zonda is a housing data and consultancy firm. We track the entire building life cycle from raw land all the way up until the closing out of new home communities. Bryan and I are specifically part of the advisory group. Our team is led by Tim Sullivan, our chief advisory officer, and we do custom market studies across the country, ranging from lot and product segmentation to population and growth research and dissecting the build-to-rent market. Don't forget, Zonda Advisory is here to help. Our advisory team is backed by our proprietary data, which also fuels our reports. For example, our market snapshots provide essential housing insights into top metros across the country, covering inventory, the economy, forecasts, and more. You can get your free snapshot at zondahome.com/market-snapshot. Our rental housing outlook, or RHO report, is also fueled by our data and team of analysts. This report covers the build-to-rent market by providing real-time feedback from operators and capital partners, rent and occupancy analysis, and a view of the BTR pipeline across the country. Know that we at Zonda are always listening to your feedback. The RHO, for example, was created by popular demand for us to better address the build-to-rent market. And we've also received requests to expand our broader database to cover many of the markets that have grown dramatically over the past few years. We've most recently added 5 new CBSAs across the coastal southern states and in Texas. We are offering an exclusive early adopter pricing for these markets until November 6th. You can check out zondahome.com/market-expansions to learn more. Another way we are expanding is through Livable. Livable is Zonda's free-to-list platform exclusively for the new home industry. We know the resale sites often fall short for consumers when exploring what newly built product and communities are out there. Livable connects consumers with the most accurate and comprehensive new home listings. We also recently acquired uTour. uTour is an on-demand interactive experience that will integrate with Livable to expand our offerings of virtual home tours. Beyond our data and product offerings, we also believe in the value of connection. As such, we still have some in-person events through the end of this year, including our brand new event, Elevate. Elevate will cover the art of high-rise living in Miami this December. We'd love to see you there. Now, finally, today's event is sponsored by Upright, formerly Fund That Flip. Upright is the end-to-end real estate investment platform that allows people to diversify into residential real estate investments, scale with fast, reliable financing, and access tools to help with project management and accounting. If you'd like to learn more, please visit upright.us. Thank you again to Upright for your sponsorship today. Now to the agenda. I'll start today's event by providing a brief, about a 15-minute update on housing trends and provide our latest forecasts. From there, I'll pass it to Bryan to go through the Texas markets. Now, where I want to start is by acknowledging what we understand to really be the story of the 2023 housing market, which is there was a tale of 2 different markets, what was happening in the existing home side and what was happening in the new home side. Existing home sales, the most recent data available, shows that the largest share of the market's down year over year, total transactions down also compared to that healthy time period of 2019. When you look at the September data for new home sales, our Zonda database captures that sales are up year over year and up compared to 2019. Now, we know there are a lot of reasons why there have been differences between these markets, but two of the key things come down to inventory and incentives. We'll talk about both of those a little later in this presentation. But as you look at the overall sales number, many of you know that we also think there's a really valuable way to cut that data, which is to look at the average sales rate. Average sales rate per month per community looks at builders that have homes to sell. How well are they selling? We don't care about supply in this discussion. And I think the key thing that we need to understand is that sales have been tougher to come by over the past few months. We'll talk about the particular shift that we've seen in October so far. But if you track out the markets that are shown here, you're finding that most markets are above where we were going into the pandemic. When we were meeting this time last year, there were actually a lot of markets where the average sales rate was notably below where we were in 2019. But when you look at that average sales rate number, we also wanted to provide more context. And so what we released yesterday is our Zonda market ranking, the ZMR. Now, what the ZMR does, it says, okay, we know what's happening with total sales. We know what's happening with the sales rate. We know that we're in a seasonal industry. So we take all of that information and then we look at what a healthy time period for each market relative to themselves is. That will include some time before the pandemic and then some post-pandemic dates as well. We do that to create a baseline, and then we compare current trends with what that baseline is. And based on that relationship, we can assign a ranking. So as you can see across the country, we have 5 different options available. A market can range from being significantly underperforming, for which we have 2 markets right now that fall in that camp, to significantly overperforming. Nationally, what we're finding is the market is slightly overperforming. And if you look across the top metros, we have 70% right now that are in that overperforming category. Anything green, overperforming, yellow would be average, anything red falls in that underperforming category. Now, an important thing as you look at this data is to know that this is delayed data for September. And I know from posting this yesterday on LinkedIn and having conversations, there are some markets that maybe look a little bit more rosy than what's being felt on the ground. And I want to provide some important context behind the CMR. So first, I know that a lot of people have felt that change in the market in September versus October. So remembering that this is September data, but also remembering that this is comparing to the baseline. And so there are a lot of markets that are cooler to where they were the past few months, cooler to where they were maybe even the past couple of years, but way above where they were in those pre-pandemic times. Goes back to that chart I showed a few times ago. But I'd say most importantly, the ZMR does not care what it takes to sell homes. And what we know is in many markets across the country, price cuts, buy downs, funds towards closing costs, whatever kind of incentive is available is really one of the keys to help get a consumer to go through with the purchase. So if you have to do a massive buy down to secure the sale, our data may still say it's overperforming. We don't really care how you got the sale. We just know that you got the sale. But as we look at incentives and we think back to that discussion of new versus existing, we know that this has been such a big driver of the outperformance on the new home side. More than half of all of the projects across the country right now are offering incentives. And when we look at what those incentives are, the number 1 most effective, mortgage rate buydowns. Number 2, funds towards closing costs. Number 3, flex dollars. Put a different way, we know some people will be monthly payment constrained. That buy down will help. We know some people will be cash constrained. The funds towards closing costs will help. We know some people just want to have a decked out new home. And in some cases, those flex dollars can help them achieve that. But what we get asked a lot is, well, what do these incentives actually look like on the ground? So if you go back to the mortgage rate buydowns, we asked builders in our monthly builder survey about those fixed rate mortgages, not the adjustable ones, but if they're offering, willing and able to offer a fixed rate, what kind of mortgage rate can someone get? You can see highest share right now is in that high fives. Your cluster is between the mid fives and the low sixes. Now, this is up compared to where we were just a handful of months ago, where the majority of the responses were in the fours to fives. And this is because, of course, we've seen that interest rates have gone up. As interest rates go up, it becomes more costly to be able to buy down the ultimate rate. If you look at funds towards closing costs, we also get asked, well, what kind of dollar amount are we talking? Again, your highest cluster here is between that $5,000 and $20,000 range. Really, in some cases, those funds towards closing costs being used in lieu of some kind of price drop. Now, we talked about how rates have gone up, and that's playing into what kind of mortgage rate buydowns are available. Right now, depending on the buyer, depending on the day, we're looking at interest rates that are in the 7s to 8s versus just 3 months ago, we had been pretty steady in the 6s. So as we're looking at the market dynamics, we still can say that the new home market is outperforming the existing, but it doesn't mean that the new home market is not going to face these same kind of headwinds, when in fact, we know that they are. As you look at the monthly mortgage payment, nationally, it's now 90% above where it was at the beginning of last year. And if you look at it by market, you can see in some markets, there's been a 60% increase in the monthly mortgage payment since the beginning of last year. In some cases, there's been a more than doubling. This accounts for home price changes and interest rate changes. So of course, affordability has been the big issue, but it's only gotten worse over the past few months. Plus, we're now facing up against the headline effect again. If you think about headlines and how they've played into the housing market, last year headlines got really bad as we saw the market pull back. And for the first half of this year, headlines were actually favorable to our industry because there were things like, wow, the housing market is performing better than expected. And so a lot of people were like, okay, housing didn't crash. I still need to buy a home. They feel a little bit more comfortable going through with that purchase. Now, as you look at the headlines, you see things like mortgage rates race to the highest level since late 2000, or home prices are likely to fall in these markets. And so consumers are saying, you know what, it's already expensive. And now I feel just a little bit less certain about that investment. And that's pushing some consumers back to the sidelines. So we've seen, and I'd say we've experienced a sentiment shift from the buyers for the past couple of months. And this is now translated into a sentiment shift from builders as well. So again, for the past couple of months, we have seen that the highest response from builders is that demand is slower than expected. But as many of you know, we like to cut this data into a couple different ways. Well, is demand slower but not worrisome? Or is demand slower and it's actually causing concern? October is the first month where not worrisome and concerning are on par with each other. So if you look at not worrisome, that's about 30% of the responses, which to me really reflects seasonality. We're here in October. October shouldn't be as strong as April or May. But then you have 30% saying, hey, this actually does feel a little bit worse than what I was expecting. And so we're calling this period right now seasonality plus. Yes, we are seeing the return of more normal seasonality, but there's a little bit of extra contraction in consumer demand right now. And that extra comes down to some of these comments. These I pulled from our builder survey, where we have things like velocity has all but died out, or entry-level buyers are priced out, move-up buyers are spooked. We're a really big part here. It's the combination of rates, insurance, and inflation that are now serious and playing into that demand pool. And so as we look at the mid-October highlights, we're able to talk about October because we do a mid-month builder survey. So this is about as current on the state of the market as you can get. And the key thing, it ties back to what we already talked about. No urgency, consumers moving to the sidelines, a bit of a return of that wait and see. Now, as you look at what this has meant for pricing, for the majority of this year, we've been in an environment where prices were flat to up. Now we're in an environment where prices are flat to down. Now, notice it's only 12% of builders that are lowering prices. I think the key thing here is prices more or less holding flat, but there's that increasing use of incentives. But let's go back to that discussion of new versus resale. And we said another key reason that new has done better is because at least builders have had some inventory to buy. And people are saying, if I'm going to pay top dollar, I like that I'm buying a brand new product. Maybe I can customize it, whatever it may be. Now, as you look at active listings on the resale side, look for the line that hasn't fully finished. It's stopping at September. That's what we're seeing with our overall level of active listings right now, where you are seeing a little bit of that increase that happens this time of year. So we're seeing that seasonal lift in active listings. But as you track this data, it's not a flow of a bunch of new listings. It's that some of the homes that are on the market are not selling as quickly, and that's contributing to this rise. Overall, though, what we're seeing is listings are still expensive on the resale side. Oftentimes, they're older homes where the seller is an opportunistic seller, knowing that there's not much competition, the price is high, and people are saying, what are my options? And that's still funneling people into the new home market. Now, as you look at all of this data and you put it together, I don't want to talk about our end of year 2023 numbers because we basically have a sense of how that is going to finish. But as we look into 2024, I'm going to start with what builders have told us, and then I will tell you what we are forecasting. So in our builder survey, I was shocked that despite some of that change in sentiment in October, in September, we still have 70% of the builders that we're talking to that expect starts to be up in 2024 compared to 2023. If you look at the distribution, look at the highest share, about 30% expect starts to be up more than 10%. Now, an important thing about our survey is we're skewed a little bit more towards the public builders. And so I saw a survey recently from another organization that surveys more of those smaller builders, and they found 40% anticipate starts to be up next year versus this year. So I think the truth is probably somewhere in the middle, but you do have that majority that expects starts to be up. Second highest response overall expects starts to be flat. Now, with this idea that, hey, starts will be up next year, that's got to be assuming that financing remains somewhat reasonable, financing to the building community, financing to the consumers, and that's got to assume that demand holds up. And as you think about how the economy has progressed and how demand has progressed, I think those two things are absolutely up for question right now. I don't think those are guarantees as we go into 2024. And so my team, there's 5 of us that meet to go through our forecasts. We look at what's happening in the economy, what's happening with policy, what's happening with demand, affordability, sales, lot supply. We're taking all of this into consideration. Where we landed, at least for now, is that we expect total starts to be down 7% next year over this year. Now, total starts is different than what the builders were saying, because largely we're talking about single family from that last slide. Our expectation is that the contraction in starts is led exclusively by the multifamily side, where we know there are more capital constraints, where we know that there are fears of a temporary oversupply in some markets, and that's keeping multifamily starts limited. At our 930 for single family, that puts us right about flat compared to where we were. Now, many of you know we like to have a lot of humility when we do forecasts, so I just wanted to show you what the range on the market looks like right now. The lowest I've seen is 880,000 for single family starts next year. The highest I've seen is 1.1 million. Now, I want to pull back the curtain really fast, though, on how we do our forecasts, because we have a PhD economist who built us out a quantitative model that tells us what it thinks will happen in the market. And our quantitative model is more negative than our 930. We said, well, our model doesn't know everything about what's happening on the ground, and so let's give it a bit of a bump up. So we've bumped up what the model says. But once we've done that, we then sit back and say, okay, well, we got to ask ourselves, we know what our baseline assumption is. If we met here this time next year and we ended up at 800, for example, why did we get it wrong? Well, let's look at some of the things that would make us too high. Part of it is rates. We're assuming by the end of next year, rates are lower than where they are today. If they're not, if they hold at this level or they go higher, all bets will be off on our forecasts. We're looking at maybe a minor recession or a kind of run-of-the-mill recession, not a major recession if it does end up hitting. And if you see a major recession, all bets are off. We're tracking supply, we're tracking inflation, we're tracking affordability, and how margin compression comes into the discussion and how long can we continue to buy down the rates and offer some of the more aggressive incentives. But then you ask, are we too low? Well, we've talked a lot about how the new home market has gained this relative share. Maybe we have a soft landing. Maybe the labor market holds. Maybe that pent-up demand ultimately releases next year. So a lot of things that we're considering here. But again, our base case down 7%, led by a contraction in multifamily, basically flat on the single family side. So with that, I'd like to introduce Bryan Glasshagel, Zonda's Senior Vice President of Advisory and Texas Expert. Bryan has been in the industry for over 20 years with a career spanning market research, acquisitions, and banking. When I asked Bryan about any lessons learned from his nearly 10 years at JPMorgan Chase, he said he saw the good, the bad, and the ugly with clients coming out of the Great Recession. And Bryan said he learned the importance of setting up your business to perform through the cycle, which I think is a very fitting takeaway today, especially following the forecast discussion. So Bryan, let me turn it to you.
Thanks, Ali. I appreciate it. Great content as always. I think you nailed it as we start to talk through what we're seeing in Texas and the markets across Texas. Part of that story is cyclicality, right? And we haven't seen that come to market for a while. It's been a pretty big run where we've seen a little bit of ups and downs, but as we've started to see, it's been a little bit more volatile the last few years going through COVID and now coming back out the other side with rates. But what we'll do today is we'll end up looking through some of the demand side factors on the economy, what's kind of still fueling demand for housing. And then we'll look at our third quarter market data, both on the demand side and the housing supply side that just came out this week. So we'll give you the freshest numbers that we have on lot supply and closing starts, all that good information. We'll do that for the four major markets. And then briefly, we'll talk through some of those secondary markets that our advisory team is working through outside the big four here in Texas. There are other markets that do a lot of starts and have a lot of activity, and you'll recognize some of the names of builders that are moving into those markets. And then we'll close out with some final thoughts of the things that we're looking at for the rest of this year. So one of the things that we've been talking to our clients about in our quarterly briefings is job growth is strong, but with the local economies kind of reaching that full employment rate where unemployment rates got down to the low 3% range, we're going to start to see those employment numbers start to pull back. And the way we're going to divide the presentation up today, and you'll see why as we go through some of the data points, we're going to look at Dallas and Houston together, and then we're going to look at San Antonio and Austin together. And there's just some trends, and for the last couple of years, these markets have all moved pretty much in the same direction. Now we're starting to see some differences between what we're seeing in Central Texas and what we're seeing here in North Texas and down in Houston. But on the employment side, what we're really starting to see, and this you can kind of see this here, those blue lines are year-over-year employment growth. The orange line is the unemployment rate. So the key trends that we're seeing here, job growth is still very strong. Dallas-Fort Worth added almost 155,000 jobs over the last year. Houston added almost 88,000 jobs. But you can see where it trended down from the beginning of this year, where Dallas was closer to 232,000 jobs and Houston was closer to 153,000. So as we get more into the economic recovery, it gets harder to put up those big job numbers, gains year over year. And the other thing that we're starting to see is, unemployment rates really started to bottom out at the end of last year. And for both these markets, and we'll show the same thing for San Antonio and Austin, they've trickled up this year. So we went, in the case of Dallas, from 3.1% up to 4.2%, as of August. And what we're seeing is a couple of things. It's really not necessarily just all job losses, but that's still the impact of migration into Texas. We're seeing the labor force grow. Takes some time for those people that move into the state to find employment. So you'll see a little bit of slack in the unemployment rates. And we're seeing the same thing as we look through Central Texas, Austin, and San Antonio. Same trends, year over year, Austin's still adding about 34,000 jobs, but that's down from almost 74,000 at the end of last year. Same trajectory for San Antonio, about 26,000 jobs over the last 12 months, down from almost 50,000 though, where we ended 2022. And the exact same pattern that we're seeing here on the unemployment rates ticking up. The thing that we want to do though, we look at those headline numbers of just pure non-farm employment growth. That's a great baseline, but we always want to look at it on a sector basis as well, because this kind of tells us, is there going to be a lot of demand for housing as we move forward? And what we show in these charts is the major employment sectors. Those with the darker blue on the left are typically the white collar jobs that have higher income levels. Some of these markets, manufacturing would also have higher income levels based on technology or oil and gas, things like that. But as we look at it, what we're starting to see here, DFW is still broad-based job gains, but Ali, there we go. Perfect. So still, it gains across all employment sectors, but we're starting to see some of it weaken on the blue collar side of it. More so as we look at Houston, right? Those job numbers came down quite a bit. And now we're starting to see either flat growth or negative growth in several sectors. And a lot of that blue collar job growth where it would have the higher income levels is pulling back more significantly than the blue collar side. The white collar jobs are actually pulling back more significantly than blue collar. So as we look at both Austin and San Antonio, very much the same trends, right? So on the white collar jobs, as we look at Austin, financial services, information sector, technology related, pulled back quite a bit. We're still seeing good growth in professional and business services. We go down to San Antonio, we actually have pretty weak job growth in information, negative job growth in professional and business services, negative job growth in manufacturing. So as we move forward, this is going to be something that's important to watch the latter part of this year into next year, because I think as Al mentioned, with rates up as much as they are, that's one thing. You still have demand coming through from the employment side, but if we start to pair high mortgage rates with job losses or less job growth, I think that's going to be a different story as we look at our outlook for housing in not only Texas but other markets as well. So as we look at the demand side of the equation, and this is where you'll start to see where we group things together. What these charts show are annual new home starts, which is the purple bar line, and annual new home closings, which is the teal line. And it's a little bit of a tale of two cities. If we look, kind of year over year, what are we seeing? DFW starts are still down 20%. In Houston, they're down 16%. But what we really want to focus on now is some of the quarterly data. And we show that off to the right. And what we saw with the strong spring selling season is builders through early part of summer were able to sell a lot of homes, and a lot of it was tied to not much resale inventory, the ability to buy down rates. There's a lot that was pushing outsized shares of overall transactions to the new home side of the market. So as they were selling through existing inventory or homes that were under construction, they realized we needed to start picking up the pace and activity. So that's what you see in that table, those tables to the right, or the boxes to the right, the increase in activity and start activity that we saw in the second quarter and the third quarter in both these markets. When we started this year, we thought both these markets would likely end up down year over year on a start basis, probably 25%, 25%. Now, as we're looking at it with the strong second half that we've seen, the second and third quarter, the start levels in these two markets likely are going to end up down less than 10%, maybe even less than 5%, depending on how we see the fourth quarter shake out. Different story though, as we look at Austin and San Antonio. And these ones, particularly Austin was one of the highest flying markets, I think as we went through COVID, just in terms of the increase in activity. Same thing with San Antonio. We saw just a rapid expansion of this market. You can see there are record levels for starts and closings, going through COVID. And what we've seen there is that weakness, even though builders were still selling a lot of homes, in Austin, a lot of the builders and developers we talked to said, they're ahead of plan for this year. we didn't see the backfill in starts. And I think there's still some concerns about the near-term outlook for the market. So as what you're seeing here, the starts are down 43% year over year in Austin. And we really, even though starts increased in the second and third quarter, it wasn't that big pop that we saw in DFW or Houston. Starting to see more stability in San Antonio, even though starts are down, again, 40% year over year. They actually flattened out quarter over quarter. So we're actually, that kind of free fall in start activity is declining. But as we look at new home closings, eventually that will impact that. As we pull back on starts, you're not going to be able to keep that same closing pace. But with the strong spring selling season, builders had inventory to sell, had homes under construction to sell. So that's why we saw those start paces, kind of gap above where the closing paces gap above where the starts were. And as we look at, kind of where's the activity in each of these markets by price segment, what these charts show is new home starts by price range over the past 3 years. So the purple on the left is 2021, teal in the middle is 22, gold on the right is 2023. In general, what we've seen, particularly in DFW, is you look at this shift in activity over the last couple of years, and this really started, as we went into COVID. Higher price points, we had double-digit price appreciation. We were pushing more of that start activity to those higher price points. Where you can see just active price point in the market right now is that $500,000 to $750,000 price segment. With that said, when we look at that core segment of the market, 300 to call it 499,000, that still accounts for almost 61% of overall activity in the market. Start activity is either up or just down slightly in those price segments. Where we're really seeing a struggle to bring product to market is at the lower price points, particularly in DFW. Below 300,000 is a price segment now, just based on where land prices have gone, construction prices have gone. It's something that's evaporating. Houston, we saw the price appreciation, not quite as much, so it shifted some, but we're still seeing about 43% of the market from 250 to 350. And interestingly, if you look at the far left side of this graph, the actually product under 250,000 increased 9% starts over the past year. So what we're starting to see there, that's location driven, lot size driven, home size driven. So it's not a huge segment of the market, but builders are adapting in some cases of bringing real entry level product back to the market in some locations. Austin mirrors DFW, what we saw there, and you can kind of see the shift in product or activity to the higher price points. Almost 60% of the market still, though, is in that core, 300 to 499,000. But you can see that broad-based declines, across the market here, by price point, anywhere from you're looking at those key bands, 15%, from the 300,000 range all the way up to, if we're looking at that 5 to 750, down 50% year over year. Very much the same story in San Antonio. San Antonio is much more of a price conscious market, based on income levels down there. So it's always been more affordable. It's still shifted up, and it kind of mirrors Houston as well here, as we look at about 46% of the starts between 250 and 350. But even at those lower price points where you would think there'd be more, significant demand, we're still seeing sizable double-digit declines in start activity over the past year. And I always love showing this because this helps us see where activity is occurring in the market. So as we look at it, this is a heat map of where start activity was in DFW over the trailing 12 months. So the darker the red, the more start activity that's occurring in those locations. If it's blue, obviously there's less activity. As we look at the 12 counties across DFW, out of the 12, most of them are seeing year-over-year declines in starts. But where we started to see it flip are in two of our more active counties, Collin County, which is up to the north, and then Tarrant County, which is Fort Worth side of the market. But where we're really seeing a lot of activity in this market, those kind of key growth corridors, that 380 corridor up north from, call it, Princeton to the east in Collin County, all the way across to Little Elm, Aubrey, and Denton County. That Alliance corridor and 287 out to the west side of the market, along I-35 West, a lot of activity out there. And then as we start to look at some other locations that traditionally have been more attainably positioned, the eastern portion of the market, Kaufman County, down south of Fort Worth, that Chisholm Parkway Trail, still key growth corridors. We've seen activity pull back a little bit more there, just kind of like we did in San Antonio. It's an edge location, more attainably priced. just more apt to volatility when we go through what we have over the past year. And as we look at the Houston market, and kind of the same story here, the heat map still applies here. Darker red is where we're seeing more of the activity. And what we see here is we look at our 9 market areas that are kind of go clockwise around the market. All 9 actually saw declines year over year. But what we're seeing here, in terms of strength and activity, and where we're doing a lot of our advisory work, you can kind of follow the Grand Parkway 99 around the Houston MSA, and where it's expanding is where we're starting to see additional growth. It's up on the northeast side of the market. We're starting to see, from Baytown, Mount Bellevue around to the Loop as we're coming back out to Humble, areas like that, up along, up towards Splendora up in the northeast. And then where we're seeing a lot of master plan development activity is going to be, kind of in 2 locations, new master plan developments. Keep your eyes on Montgomery and Magnolia to the north. And then as we go out to the northeast along that 290 corridor, it's going to be a little bit more attainable, a little bit higher price than Cypress. But as we start getting out to Hockley and then out towards Waller, we're going to see a lot of growth out that way. And then down south in Fort Bend County around Rosenberg, Beasley, Highway 59, we're going to see a lot of activity out in that side of the market too. So a lot of it is tied to infrastructure improvements, but those, like in most markets, we kind of see it growing along the edges of the market. And as we look at Austin, Austin, where we've seen, kind of the biggest slowdown in activity, in the market, what we see here is the strongest growth, even though it's starting to lighten up a little bit more. We still see a lot up in that Georgetown market, and that would be all the way from the Highway 29 corridor, from I-35 all the way out to Liberty Hill, and then down south into Hays County, all the way from Buda, Kyle, San Marcos, and then kind of emerging areas as we look east. And again, it's tied to those infrastructure improvements along the toll road, the 130 out east, Hutto, Taylor, Elgin, Gaynor. And then down south, a market that just a couple of years ago had virtually no new home activity, but Lockhart, we're starting to see more builders go out that way, Horton, Lennar, KB Home, and we're starting to see a lot more larger developments that are in the plans in that location as well. So something to keep an eye on there. And for San Antonio, kind of the shift we've seen in this market, if we went historically, again, starts are down, significantly year over year. This was really, in terms of market concentration, the west side of the market for a number of years was one of the more active locations. It still is when you look at the individual market areas, still accounts for about 26% of the market. But where we've seen a big shift is down to the south side of the market. And it's really an area that just a few years ago had pretty limited activity, but we're seeing more developers, more builders down in that side of the market, high quality development going in down there. So we're seeing that side of the market open up. New Braunfels is still, in terms of absolute starts, it's still our second most active market area, and that's up in the northeast. What we're seeing there is some of that activity is starting to slow, and we'll have to see if it does over time. They raised impact fees this year that will go into effect for new communities. Impacts, not as much on the higher price communities, but those more attainably priced communities along 35 and south of 35. That's going to have an impact, I think, on development activity there. That's why we're starting to see some shifts in this market in terms of where new home starts are occurring. As we look at the price trends and what we're seeing in the market, so if we look at DFW, and these are going to be very similar from market to market, new home price appreciation, what you see here is the blue bar is the average new home base price over the trailing 3 months. That orange line is the year-over-year price appreciation. So what we saw, going back to 2022, before rates started to increase, where new home prices were appreciating at a pace of almost 23% year over year. Rates started to increase, and what we saw were prices having to be adjusted on the base price basis. And right now, as we're looking at it, it's relatively stable year over year, and the year over year comps are getting more challenging. We're actually seeing base prices down 3% year over year in DFW, kind of a similar trend in Houston. We peaked at 19% price appreciation, and now we're down 3% year over year. But as Ali mentioned, base prices is just one of the things that we look at with builders. It only tells part of the pricing story. It's usually the last thing that moves. But builders, in order to get those sales, they did a lot of hard work in the fourth quarter last year, a lot of hard work in the first quarter of this year, and some of it was base price movement. but a lot of it was those mortgage rate buy downs. So whether it's an inventory, mostly focused on inventory homes, but build jobs as well. When we're talking to our clients in the market, to buy those rates down from 7.5% down to 5.5 or 5%, it's costing them 6, 8, or 10 points to buy that down. So if you think of base price on a home, if prices are down 3%, you add in a 10% incentive, that's down 13%. There's some challenges there. And then, I think as we look forward, where the challenge is going to be bigger is land prices have been sticky. So even though we've seen movement in the home base prices and incentives, land prices have remained pretty sticky. So as we got to those new communities that come to market that don't have these legacy lot contracts, that's going to be something to watch. It's going to be harder for that margin's going to compress on those communities versus where they are today, just because you have higher land prices, high incentives, and potentially reset base prices. And we see the same thing when we look at Austin and San Antonio. Again, almost mirrors what we saw in the other two markets. Price appreciation peaked at almost 26% in Austin, down about 3.5% now year over year. Similar in San Antonio, actually peaked just under 20%, down now 7% year over year. Again, there's big incentives on top of those. But the good news is, with that, the builders have been able to grab market share from the existing home side of the market. Then they've been able to move homes and they've been able to move inventory. So it's been a little bit of a boon for the new home market this year. And as we look at the housing supply side of the equation, we'll look at a few different dynamics. One of the things that we track each quarter is finished and vacant inventory. So these are standing inventory homes in the market that are finished, ready for a buyer to move in. Two things here. If you're looking at the bar, that's the actual absolute number of homes that we counted in the market. The diamond is the months of supply. So for months of supply in these markets, we consider 2 to 3 months to be equilibrium. So even though when we look at these numbers and you look at a Dallas-Fort Worth where that finished vacant inventory is up 61% year over year, the month supply is up 50% year over year, it's off a very low base. When we're going through COVID 2021, 2022, demand was outpacing supply. So we're able to move through that and there wasn't much inventory on the ground. But even with those increases, we're at 1.8 months of supply in DFW, 1.9 months of supply in Houston. And with that, there's incentives that are moving those, yes, but it's not something that is at a level at this point that we're concerned that the builders aren't going to be able to move those. And I think, again, as we look at the lack of resale inventory, that's a big bonus for builders being able to move the supply pretty easily if they price it right. Very similar trends as we look at Austin and San Antonio. Very low basis. If we went back to 2021, you had less than a month's supply of finished vacant inventory. Now it's up to just under 2 months, but still below what we would consider equilibrium. The other thing that we're watching is those vacant developed lots on the ground. As we look at that, so those are finished lots that are ready for home construction to begin. As we went through COVID, developers could not deliver lots quick enough for builders to use, right? Builders were using them quicker than they were being delivered. And that's why we saw those numbers drop to record lows. So if you look at this chart, that VDL inventory, those vacant developed lots on the ground, purple bar, new home starts is the teal bar, and then the diamond is months of supply. Months of supply that we look at here, generally 20 to 24 months is equilibrium. So if we look at DFW and Houston going back to 21, we had less than half of the normal supply that we would expect in the market, down around 10 or 11 months of supply. As we went through the past couple of years, particularly the last year, start activity pulled back. There was a lot of lots that were under development and being delivered. And that's what we saw, that rapid increase. Start levels decreased, deliveries increased. Now we're up to about 22 months of supply in DFW, about 19 months of supply in Houston. Good news is for both of these markets, those levels have likely peaked, right? We're starting to see start activity increase. We're actually seeing lot deliveries come back down. So I think we peaked here without getting to condition of oversupply. I think that bodes well for both of these markets. A little bit different story as we look at both Austin and San Antonio, right? It's still kind of the same story. As you look at where months of supply were just about a year ago, either the end of 21 or mid 22, you had about 11 months of supply in both of these markets. But when you have a 40 or 43% decline in start activity and near record level lot deliveries, you can see how quickly that months of supply jumps up. Almost 28 months of supply in Austin, almost 30 months of supply in San Antonio. Again, I think for both of these, even though it's not showing it as much here, I think this will likely be the peak levels because we're seeing deliveries start to pull back. And I think as we move into the back half of this year, early part of next year, we'll have to see start activity start to rebound in these markets as well as builders are moving through a lot of the homes that they have under construction. So even though it's showing a little bit of oversupply at this point, I think it's going to be short-lived and not anything as we look at the outlook and you look at the longer midterm, longer term outlook for DFW or these markets in Texas. I think these numbers come back down pretty quickly. We showed it, not just by the overall market, but what are we seeing in some of the individual market areas as well. So as we look at DFW, what that chart shows is the 15 most active cities within the market. And as you look at that red line, that's about 24 months of supply. So there's only one area, McKinney, or city that had more than 24 months of supply, and that's probably tied to just a couple of communities there. But a lot of our most active communities are still lot supply constrained. So as we're looking at Fort Worth or Princeton or Aubrey or Prosper, Salina, we're either at or below equilibrium levels. Same thing in Houston as we look at those market areas around the market. And again, left to right, most active to least active. Those most active parts of the market, the Northeast, the West, Northwest, or the or central portions of the market below 20 months of supply. Far North has a little bit above, but I mean, that's where we're seeing a lot of new communities, broad market. And as start activity catches up, those will start to come back down. It's going to be a different story though, as we look at what we're seeing in Austin and San Antonio. So you look at Austin, again, these are the most active cities, left to right. You look at Georgetown, a little bit oversupplied, the city of Austin itself undersupplied, Leander undersupplied, Hutto undersupplied. Why we're seeing those undersupplied, some of those locations just don't have a lot of lots on the ground. Some are more built out than others, but those high growth areas like Buda, Georgetown, Manor, Liberty Hill, all are oversupplied at this point to a degree. Again, those will likely come back down as start activity returns. Same thing as we look at the San Antonio market, those most active market areas, the south side, the New Braunfels, the west side of the market, all have more than 29 or close to 30 months of supply. Again, look for those to improve as we move into the next quarters. So let's take a look at some secondary markets. It's always interesting to show those big ones, but over the last year, we've worked in a number of different markets outside of the big four. And we'll just go over some of them. They're all kind of satellite markets, if you will, to the major markets here in Texas. Sherman Denison, north of here in DFW. And all I'm showing on this chart is activity in the Sherman and Denison ISDs. Grayson County itself goes all the way down to the northern bounds of the Dallas-Fort Worth metro area. So a lot of the activity along that border with Collin County, Van Alstyne, Gunner really flows more to DFW. But if we're looking at just the Sherman and Denison areas by themselves, we're seeing about 300 new home starts over the last year, about 1,500 existing home, 300 new home closings, about 1,500 existing home closings. What we're seeing up there though, interestingly, it's a standalone market, but we're seeing a lot of investment on the chip side. Texas Instruments is expanding. There's other chip manufacturers going up there. A market to watch, because you look at these top 10 builders in the market ranked by closings. 7 of those builders are builders here from DFW. Some of those are national builders. Some of those are very large regional builders, but it's not just local builders in the market. So again, I think we're going to see more activity, in this market, more builders from DFW looking up there. So we look at College Station and Bryan, that's to the northeast or northwest of Houston. It's the home of Texas A&M University, doing almost 1,000 new home starts or closings over the past year, almost 3,300 existing home closings. The difference here as we look at this is we don't see as many of those larger either national public builders or or Texas-based builders. We've got Horton there, Legend Homes, Century Communities, and then you've got a lot of builders in there, the Stylecrafts, the Omegas, that are large builders that are playing in that central Texas space, whether it's here in College Station or across to Killeen and Temple or up in Waco. decent sized builders, but we haven't seen as many of the builders move up here from Houston yet. I think we can see that as we move forward, though, just based on the number of closings that we're seeing in the market. Another one, I just mentioned it, was Killeen Temple. This one is just north of the Austin MSA, Bell County, and it's kind of seeing spillover growth effects. It's a lot of it's along, I-35, so it's a big industrial market. It's also the home of Fort Hood or Fort Cavazos now in Killeen. And what we're seeing here, almost 1,800 new home closings over the past year, over 8,000 existing home closings. So you start to look at some of these, they're a lot bigger than you would think, being located at, adjacent to larger MSAs. And only now are we starting to see some of the builders move up there. Again, it's you've got the Stylecraft and Omega, the Crothers Homes, the big local builders, but then you've got Horton in that market. You've got KB Home, and then Saratoga coming out from some of the larger either public builders or regional builders. Then the last one we'll look at is Corpus Christi. Now this one is, you can call it a quasi satellite of San Antonio, although a lot of the builders down there are local. DR Horton entered that market through an acquisition. Why I say it's kind of quasi satellite to San Antonio. Lennar is actually in that market, and they're operating it now as kind of a satellite of San Antonio. I think it'll be standalone at some point. But again, look at the size of the market. There's about 1,000 closings over the past year, almost 7,600 new existing home closings. It's an interesting market. You don't hear a lot about it. It's obviously has the beach side of it, so a lot of tourism. Tesla's doing a lithium refinery down there. And it's also home to a number of naval and military bases. So it's got a broad-based economy, decent sized market. So these are some to keep your eyes on as you're looking at opportunities outside of the main four. There are opportunities throughout Texas in different markets as well. We'll close it up with some final thoughts. So as we look at it, I think what we saw, some of those early slides is start activity is really starting to stabilize. It still looks, it's still declining somewhat in Austin and in Austin, but the other three markets stabilizing are actually starting to increase. So I think what we're going to end up seeing at the end of this year, particularly for DFW and Austin or Houston, is start levels that are declines that are much lower than we originally anticipated, and a little bit lower potentially in San Antonio and Austin, just based on what we think we'll see in the fourth quarter. But as we look at it, we still think, and we know mortgage rates is still a big role in everything that we talk about, but it still has a little bit of a tailwind to the new home market as it relates to demand, right? It's builders can offset those higher rates with mortgage rate buy downs. The existing home side of the market cannot. Now we're seeing upwards of 30% of total transactions going to the new home side of the market versus levels that are typically 20% or lower in normal markets. The big flip that we saw in the second quarter of this year, once we saw that the spring selling season was pretty strong, is a lot of the builders and developers were started to kind of shift the mindset of, okay, we know we have to work through 23, maybe 24, but we need to build the pipeline for 24, 25 and beyond. And that was kind of the flip as it relates to new land positions where we're seeing MUD activity, MUD districts that we're working on, or new master plans that we're helping builders bring to market. Big shifts. So I think that mindset is we've got to prepare. We can't gap out. Love to comment. We heard last week at our Dallas deal makers from Zach Thompson, who's going to be heading up History Maker. He said in this industry, you can never go pencils down entirely. And I think that's so true, because if you do, you're not going to have that pipeline that you need when the market conditions do turn. The thing that we're going to continue to watch is that slowing employment growth. And I think that, again, it's a trend to watch moving forward, because if we have that slow too much, or if it goes to a contraction, if you have contraction and high rates, I think that's going to have some, present some challenges to start forecasting, closing forecasts as we move forward. Mantra that we continue to hear is higher for longer as it relates is related to rates, right? We can see the light at the end of the tunnel. I just don't know how long that tunnel is. So I think for builders at this point and developers, start thinking of those additional ways to offset affordability beyond buy downs. And that could be lot sizes, going to smaller lot sizes. We've seen most of the markets, including here in DFW, shifting a lot more to product on 45 foot wide or even smaller lots. Looking at what finishes are included in those homes, is there ways to pare that back? Then the product itself, is there ways to simplify it? And I think that goes hand in hand with the lot size. If you have a smaller lot size with lower land basis, it's going to have a smaller home on it. If that home can be simplified some, you can bring down the construction and the final delivery cost. It'll be an offset longer term as we wait for rates to come down. And then finally, we didn't talk about it too much today, but we're still doing a ton of work in the BTR space. It's definitely down, but not out. And I think what we're seeing right now is it's getting harder from a capital market side for those deals to pencil. There's that cyclicality that we talked about, that this version is relatively new, so that hasn't gone through the cycle. So knowing that rents are going to go up and down, or occupancy is going to go up and down, or cap rates are going to move, it's part of that capital markets equation. The impact of property taxes in different markets here, particularly where there's a mud district, things that need to be worked through. But I think as we come out the other side, first time in a long time that we've had rents that are actually make more sense than home ownership in terms of a cost basis. I think it's going to be a long-term tailwind for this market. And we'll see those our developers are already adapting in terms of product type that they're bringing to market. So it's something we're going to be focused on. And I think it's going to be a long-term product as we look at this market. And with that, I'm going to wrap it up. I just want to say, thanks again to Ali. Great job. Again, thanks to the Zonda marketing team for putting this together. And we obviously appreciate our sponsor, Upright. And as we look at this, the recording of this will be on our social media channels and our blog within about 24 hours. If you want more information about our upcoming webinars or economic reports, podcast, anything else, scan this QR code and you'll be good to go. So thank you for attending, and we appreciate the partnership.